Hey traders, Jeff coming back to you here on Monday, March 10th, 2025. I just did a review the other day about the markets, a couple of days actually, but I felt that today was so significant enough that I would take a few minutes and just kind of outline where we are again today going into this new week after this huge market meltdown. Number one, the Dow reached just about 1,200 points down before a little bit of a regression here, and we got back to about that eight or 900 down. Nasdaq impressive, over 4.5%. I think it closed around 4% or so, but just under. But we're around 4.4%. You don't see days like today very often at all. And this was definitely a huge all hands on deck type day when it comes to the Dow, or the Dow and the SPY and the Qs. You see the volume in here in the SPY here over 108 million. Actually with post-market and all, but actually with the SPY here, 98 million shares in here. It's still going on here in post-market. So let me break down today what actually is going on, because there are some things going on here. A little bit more continuation of this tech rotation. We came out another 4.5%, 5% of the tech again today. Concerns with tariffs, Canada flipping back tariffs at us, just almost like a little bit of a tariff shift back and forth. But you also have some important numbers coming out this week and next week. So let's take a few minutes to review that so we can kind of get an idea of where we are going for the next few days. Okay, traders, once again, let's take a look at the one-day performance in the sectors here. You can see that continuation, that sector shift or rotation is still in play here. Let's point your attention to the technology. We've been kind of focused on that for the last few days, another 4.45%. You saw the SMH definitely got out of bounds on the yield, would not bounce till the end of the day, a little bit there. But this is probably puts close to 10% in tech in the last, I think we had a 3.5, 4.5, and 4, which is probably 10, 11% in tech. Now, typically the market in general from the S&P 500, we're down about 9 points, I guess probably 9.8%. Now, we don't actually enter into a correction until we get into 10%. And then bear markets typically start around 18, 22% range as well. So we'll take a look at those in a second, but take a look here what held up. Obviously, energy usually holds up in inverse. Real estate held up better than a lot. Consumer defense did. But if you look down here, consumer, cyclical, and the communication services and the technology are the ones that got hurt some of the worst. So again, just a little continuation here as that sector begins to rotate out. Nobody said anything when the technology was going straight up for weeks and months on end. So when you see this type of downplay, you think the sky is falling. And it seems like it is, but in reality is that sometimes things get just extended to the high side. It's correcting itself. It's rotating back out, profit taking some of that profit out. It looks damaging to one effect. But you got to remember, there are people owning those positions up in there. And so people likely will sell off of those. And so we're not quite there yet, but we are at a stage. I'm going to show you some percentages and whatnot in a few minutes, or at least some technicals in a few minutes that might give you a little bit more insight on where we think we're going in here. So what happened today? Bearish rotation, technical weakness continuation. They've been rotating out here, and also the financial markets, JPM, Wells Fargo, Citigroup. So the S&P 500 saw a shift in sector leadership. We've been talking about that. Defense stocks are holding up a little bit better, and obviously some of the energy stocks as well. And what caused it, obviously, high yield sell-off and rising yields. Investors fled from high yield assets due to rising Treasury yields. Why does that make a difference? Because when Treasury yields increase, safer government bonds offer higher returns, making the high yield assets more risky. So they sell off those assets. And then certain things have a bigger take on that, like IWM. A lot of the small caps get hit a little bit harder in some of these here because they don't hold up as well. But that was really a big reason, one of the big reasons why we had to sell off today. And another thing I want to point out to you, Tuesday, March 11th, tomorrow here, we do have the job openings here, JOLTS report come to 10 o'clock. Nothing really today, but look at Wednesday here. So another good reason that the market may hold its posture down here. I'm not saying it won't bounce. I'm not saying it won't have an uptick, but I'm just also realizing that usually big money doesn't want to come back and get ahead of numbers, right? They aren't going to commit because they don't just roll in a position and roll out of position like you and I may do on more of the retail side. So with CPI numbers in here, that could be a little bit of a holding pattern for stocks to kind of get a tepid bounce, probably 21.8% if we're lucky, 21.6 if we're lucky, or we just chop around and we may grind lower, if possible. We'll take a look at the charts in a second. But see, if we did move higher, I would say it'd be to the low side. So don't get too ambitious about buying off the bottom in here, because you have some major numbers coming in with CPI. And also keep in mind, next Wednesday, you have federal open meeting policy of FOMC. So there's going to be a lot of eyes focused on that, because the Fed's been leaning towards at least putting the narrative out on rate cuts, that maybe they're going to do fewer rate cuts than less. Well, a lot of that will depend on how these CPI numbers come in this Wednesday. So if CPI numbers come in well, the Fed could hedge themselves a little bit and begin to give a much less of a hawkish outlook going into days and weeks coming to the next FOMC meeting. So we'll take a look at that as we get closer to that area. And now finally, let's take a look at the SPY. This obviously has been one tremendous drop. You can see a couple of things going on here. All this happened here. It started with tariffs, and then, things begin to kind of mount from there. If you see a couple different trend lines in here, you usually draw 2 to 3 different lines. You can see the broader market, the S&P 500, has an initial trend line that's out here, which would be probably a pretty good angle trend line. If you redraw that trend line from this wide range bar that ignited as it moved up and created more of a higher level pivot, you can see that that is straight down. But the overall main primary one is still in play. Now, you're seeing distance from here to here. Now, when you normally see that, the market doesn't like to be too far from the trend line either. But in the secondary trend line, it's really not. The question is, does it spark that bounce? If we put a Fibonacci on this, I always like to kind of see what the possibilities are from a bounce perspective from where the recent sell-off was to here. If you look down here, this is 23.6. That puts us at 569. That's not that far over. Basically, it was the beginning of today's bar. That would be a retracement, a decent retracement, just to kind of gap up into that bar, maybe run higher, and still is very, very weak in a sense. Again, that was probably where we would probably go if we were to go to the upside because of CPI numbers and, of course, FOMC. So again, if you look back at the history, the market doesn't get too ambitious ahead of those numbers because it doesn't want to have to unwind those positions, because it takes days and weeks and even longer to get in to create the position. So, but that's there. If you take a look at the spot, the cues here. So the Nasdaq 100, you can see down in here. This doesn't really have a secondary trend line. It's just a primary, just kind of a first trend line. It shows you that tech did not give you that stance where you had a trend and then it regrouped and then another trend. It's just been straight down. And that makes sense because of the way the tech market has been selling off profusely. If you take a look at the Qs today, I mean, just look at the top to bottom in that. We had a low of 468.78. We were down from just the market about 22 points at one point in time, not counting the gap, right? The gap down here, 492 was where we came from, 82.72, 68. We're probably pushing 24 points down. That is one of the larger drops that I've seen in some time. I'm sure back in COVID, and I'm sure back in housing debacle of 08, there were a similar type posture. Of course, the Dow and the Qs were a lot lower in price, less than 10,000 at the time. So these drops manifest themselves and they come out with a much greater speed. The rate of change, and you saw in some of the options today, was, a 1 minute bar getting $2 to $3, and some of those rate of change. It makes it very difficult to be able to just figure out where that bottom may be. You may be right. You maybe think you're far enough from the market, but the market seems to kind of Pac-Man that up pretty fast. Take a look at the Nasdaq here. Again, just going to see more of the same. This is you can just see here, this from a price perspective down to here. What a drop down in here as well. We lost around 700 points, and we were down quite a bit further at the bottom in here. But you can see, once again, look at the trend line. There's no reaction. Doesn't have this primary, then it goofs. It's basically just been straight down, and that's just a product of the way the tech has been selling off. And then finally, we can see the IWM. This is where a lot of these get hit pretty hard too. You can see earlier on the trend line, then the new trend line coming down. So this has been beat up. So anything that thought that the small caps are really going to get aggressive this year, they were definitely had some nice move up here. But once this kind of finalized and double topped here about December of last year, things just got ugly. We were sitting here around 244. Today we were pushing underneath 200 in the IWM. So anyway, just amazing things going on in the market here all of a sudden. Again, so that's the Qs, the SPY, the Nasdaq. Let's take a look at one more item in here. And that would be the S&P 500. And you can see typically if you take the top here and the bottom down to the wick at the bottom here, we were about 9.5% drop from the 6147 area. Typically over 10% you start getting the correction area. That's not anything new. You hear about it every time it happens on CNBC. They said, the SPY or the Qs in bearish territory, and that's what they start talking about. You get a little bit further down in that 20% range, you start getting into correcting there. So we're not near anywhere where we might see a correction down in there, but we are a pretty good clip down when you think about just the distance it's made up in a short period of time to this level. So it's one thing to be here and slowly work your way down to there, right? You would think that would be a little bit more of a kind of contour type sell-off, but the rate that which we came down definitely has you kind of concerned about the move. Look how it handled the pivot in here, the yellow line. This was at 570, 57.39, and also where we dropped at the 200 period moving average. We seemed to want to close above it until the gap today, and it never really saw daylight. 57.0537 was the tall, and that's all it was. It was straight off selling from 57.05 down to 5,564, and of course a lot lower here to 55.66. So just been an amazing turn of events in the marketplace here. Just be nimble. We're telling our traders in the room, we're taking shots here and there. We did not have a successful trade today, ironically, in the spread play. Actually, we did and we didn't. We had one early, we just didn't have one late. And we're holding back on new plays because we don't know when this thing is going to bounce. If you look at climactic volume, you're seeing volume way the heck up here. Well, I do want to show you one more item that came to my attention today when I look at the SPY, and I'll have to bring this up in here. And this will make a lot of sense. You look at RSI, we actually went down, we were at one point below 30 in the RSI today. Now, we haven't been below 30 in the SPY for some time, right? You're going way back here in August of last year, and maybe a little bit here in mid-April, coming into May of last year. And then, of course, you're going into the year before. So there's only two other times really in the last year, I would say, that we've even gotten near these areas. Now, each time that we did bounce right off. This happened on the yen carry trade, ironically, and then it bounced from here. But the other one was just kind of a pushback. Once we got down to the RSI 30, we did bounce. Is this any different? I think this is different. I don't know that we will make that type of bounce. There's a lot more information in there now than we had back here. This pullback to this stature is quite complex. So I don't know that we're going to have that right away. From the item I just talked about, we are breaking the support areas. We're coming through down in here. We are looking at new areas down here where it's possible where the market could even go up with short retracements or trends, retracements back up, and then they maybe fail again. So we'll have to see. So I'm just trying to be a little more nimble, taking your shots where you can, keeping your shares a little bit lower in this environment, or your contracts a lot less. I'd rather have a little bit, or if you lose a little bit, versus trying to be all in. This is the environment kind of speaking to you that, hey, it's a good time to back off the share size or the contract size until this thing gets settled out here. So hope this helps, and you guys have a great rest of the trading week, and we'll come back at you with some individual plays as they begin to materialize in here. Thanks again for attending. We'll talk to you soon.